Thank you for watching the CEO Barbecue. My name is Antonio, and today I'm taking you with me all the way to the US again, and specifically Utah, and maybe towards the latter part of the conversation, Idaho as well, where we're going to be looking for a revival in gold. Joining me on the barbecue today is Hugh Agro, who's the CEO of Revival Gold Corp. Before we get into the actual interview, though, I'd like to warn you that we have received monetary compensation for the production of this video from the company that's being interviewed. Please understand that this channel is a business that sells content producing services to companies, which means you cannot rely on this video for research, and you should treat this as an advertisement instead. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. Please only watch this if you know what you're doing. This interview is intended only for experienced junior mining speculators, because mineral exploration, development, and mining is a very tough business where failure is the norm. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, so before continuing on, please talk to an investment advisor with a good long-term track record, because your capital is at risk, and I am neither a licensed financial advisor nor do I have a good long-term track record. If you're not 100% sure you understand 100% of the disclaimers I just showed you and told you about, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said therein. That all said, Revival is listed as RVG on the TSX Ventures Exchange, where over the last 3 months, an average of about 130,000 shares have traded daily. The stock's 52-week high is 44.5 cents, and its 52-week low is 22.5 cents. And I'm seeing a 50 and a 200-day moving averages at respectively 29 and 30 cents. With a market cap of just over $63 million and almost 200 million shares outstanding, today this is a 32-cent stock. Now, I'm not doing a full company overview as I typically do here, because Hugh and I just did a corporate strategy deep dive not too long ago, and there will be a Revival Gold playlist linked in the description of this video, where you can see the previous conversation as well as all the future conversations that Hugh and I will have. What we are doing today, though, is discussing some of the recent news, that some of the recent happenings over the last month or so. And Hugh, I'm looking forward to the conversation. But of course, first of all, thank you for being here.
Oh, thank you for having me. It's really good timing, bringing on your audience to this story over the past month. A lot of developments.
Pleasure is all mine, of course. And there have been a couple of developments. We have, well, essentially two big topics to cover here today. You've got an updated geological model that is relating to your PEA, which, as far as I understand it, you're still expecting within the next 2 months or so. And then you've also raised some money. You've raised some money with Dundee Corporation. And let's maybe start with that. Why raise money, and why now?
Yeah, very good question. We've got this PEA coming out within the next 2 months. And we have had a lot of corporate interest in Revival Gold. And we've been entertaining folks in our data room and talking about the project. And we felt it was really important at this time to take the step of bringing a strategic investor into the company's capital structure. And not just any strategic investor. Dundee Corporation has a long history in the precious metal space, forming some of the industry greats, including one of my alma maters, Kinross Gold, but also Repadre, Sabina Gold and Silver, and more recently Dundee Precious Metals. Was formed out of the Dundee Corporation and the Goodman family's efforts. So these are really well-regarded technical and financial experts in the mining space, in the precious metals mining space in particular. And we've now got them in our corner as a 5% shareholder. And we certainly welcome their input as we tackle next steps with Revival Gold. And the very first one, of course, coming up next is going to be this PEA on the Mercur project. So we've now got a strong corporate strategic and some exciting news to come.
I know John Goodman, actually. I've met him a couple of times, and I've done a couple of interviews with him over the last couple of months. And that is part of what I wanted to talk to you about today. So maybe you can be more specific on why Dundee. Like, what are some of you mentioned synergies and stuff like that. What exactly do they bring to the table for Revival Gold shareholders?
Well, a few examples. Within Dundee Corporation is a subsidiary, Dundee Sustainable Technologies, which has some really interesting technologies around metallurgical recovery. And we've been doing some test work with Dundee Sustainable Technologies (DST) over the years, and there's some really interesting applications to our phase two. As we think about milling at Bear Track Arnett in Idaho. So that's one thing that's pretty interesting to us. But more broadly, Dundee has some really super people in the area of technical, so understanding geological models and understanding metallurgy and understanding the business of mining and how to optimize mine plans and how to finance them optimally as well. So there's some really interesting expertise there, and then on top of all of that, of course, the Goodman family, Jonathan Goodman, just a super industry leader. As an advocate for a number of very important industry initiatives around education, around science, and of course around good practice, ESG. These are all things that we ascribe to, and so there's a lot of there's a really good fit here in terms of Dundee Corporation's expertise and interest and strategic intel. So we will certainly be working together on that as we continue to progress the company. And I can tell you, Dundee Corp has really high ambitions for Revival Gold and big plans. So I think that's going to dovetail well into our thinking and our shareholders' interests.
But this financing was essentially specifically for them. So to get them involved, there's no one else participating, as far as I understand it.
It's to position Dundee. We did bring in one of our other key shareholders just to manage their dilution, who's one of our other institutional shareholders who's been extremely supportive along the way here. But unfortunately, we needed to keep it tight. We didn't want to issue a lot of stock in this financing, and so we weren't able to broadly make it available. And for good reason, right? We wanted to minimize dilution, continue to drive value with the PEA coming up here very shortly, and with plans beyond.
So, because this would have been my follow-up question as well here is insider. So, are insiders participating? That's kind of a typical question that I ask when people do financing. So, yeah.
The answer is no, and the reason is that we didn't want to be seen to be ahead of our fellow investors as a management and board. In fact, I'm buying in the market now as I'm off blackout now that this transaction's been announced, and personally buying shares in the market. So that's what we're doing alongside of our existing shareholders, as opposed to participating in in this private placement at this time.
How far does this money get you from a milestone perspective, but also maybe from a timeline perspective?
Yeah, no, to be honest, not very far. It will be, we'll be very good through the PEA announcement. The work we want to do with some of those corporates that are showing interest in us, and also more broadly marketing the results of the PEA. We think this is going to be a very big moment for Revival Gold. I think I've mentioned before to you, Antonio, that we do expect to double our underlying NAV. We've got a lot of resources on the project, and the trick now really is to turn that into NAV and then ultimately into free cash flow. So that's the path we're on. We think this is a big milestone for us, and we want to get out and deliver that message. The cash we have on hand, about $4 million pro forma the placement with Dundee, takes us out into the fall this year, and that gives us ample time to firm up our plans for follow-up. A lot of the follow-up on Mercur in particular, on the permitting, on the drilling, on the engineering works, will fall out of the recommendations from that PEA. So we're really waiting for that PEA to get completed and all of the I's to be dotted, T's to be crossed on the recommended follow-up programs.
So essentially, it's because that's also a typical follow-up question that I have is what percentage of this money goes toward advancing the projects versus what percentage goes toward G&A? I mean, including the marketing that you're talking about here.
Yeah, so when I talk about marketing, I mean just getting out and telling the story. I'm not talking about spending a lot of money on marketing. We're pretty light on those kinds of activities. Our money tends to go into the ground. So most of this money is really dedicated to completing those PEA steps, the permitting timeline steps, setting us up for future drilling programs, making sure we've got all of the pieces lined up for that. And then the engineering works. I mean, we've got to formulate our plans around the engineering works, lock down on consultants for steps related to permitting, baseline collection to the extent we've got to do that. All those things cost money, and we'll be focused on those efforts. Our G&A, as you may remember, Antonio, is not running much more than about $150,000 a month at Revival Gold, Canadian, which is lean and mean.
Yeah, that's about what 100 grand in euro. That's kind of how I think about it. The financing gives, as you mentioned, Dundee, it gives them about a 5% ownership of the company. How much decision power and sway will they have from an operational perspective here? I mean, you talked about the synergies earlier before, but are they helping, or are they also helping you decide, if that makes sense?
Yeah, there's no governance provisions under our arrangement with respect to this placements. There's no board appointments. There's no management appointments. There's no oversight on budgets or direct control on the company. I mean, this is key. You'll recall that my background comes out of M&A, strategic activities for majors, Placer Dome, Kinross, and others. And as we think about the landscape, we think about it from a point of view of how do big investors and how do big corporates think about these kinds of strategic placements that companies like ours do. And we wanted to make sure that we didn't impede any future corporate action by one step with one strategic investor. And part of the reason why we selected Dundee Corporation for this is that they were willing to work with us on a relatively hands-off basis. That is not to say that we don't welcome their input, and that's a key point I want to leave you with here. I wouldn't call it synergies, but I would call it respect. We have a ton of respect for Dundee Corporation and the value that they bring to the table, both technical and financial, and from an ESG perspective. And so we are going to be listening, and we're going to be taking on board that input. It's key to the success of businesses like ours to be open to input and ideas, no matter where they come from, and especially when they come from proven groups like Dundee.
This is actually part of what I was wondering about, and maybe we'll touch upon it here at a later stage. But you've also granted Dundee a ROFR, essentially a right of first refusal for a period of 6 months, which gives them the right to participate in future financings within that 6 month period, of course, and kind of maintain their ownership on a pro rata basis, which is that's not too curious. That's not something I mean, I'm not surprised by it in and of itself. But do you expect having to raise money within that 6 month period?
I'll tell you, we don't think about it as to timing, when we have to raise money and when we don't have to raise money. We think about it in terms of strategic value to growing the business, right? So if it makes sense to bring in a partner like a Dundee to drive credibility, to drive the exposure we get, and to help with strategic insights to continue to build the business, then we'll do that, even if that's 2 months before we put out a PEA result. So you've seen us take strategic steps that, although we don't really need to take money from Dundee at this point in time, we did want to bring them in and make them a partner in the business and shareholders alongside of our other shareholders, and for good reason. So I think what we've done with Dundee and what we've done in the past is going to be illustrative of what we'll do in the future. And if we see an opportunity to do something strategic We're not going to let financing be the chief reason why we take a step with a party becoming an equity shareholder in the business. It's an important step. So short answer is it depends where money is coming from. It depends what the intent is behind that money, and it depends on all the ancillary things that come with it, as well as timing.
And that's part of it too, right? Because that's something that I did write down that I wanted to ask you. Does having Dundee in there and them having the ROFR in the first place prevent other potential strategic investors from jumping in, or because based on what you're telling me here, I'm getting that you still think that there's room for more strategics, essentially.
Without being too specific, what I'm saying is that there's a lot of corporate interest in Revival Gold. And so we want to make sure that we've got our PEA complete, and that we're coming at it from a position of strength when we think about our next steps funding the business. And there's all different forms that can take. Again, I'll repeat. I mean, I come from a strategic background. I'm a shareholder first and foremost, and so the way I look at it is, how do we deliver the best outcome on any transaction, small financing, big financing, corporate M&A, that we can for our shareholders? And so we're looking at all of those possibilities, and we continuously do. I think the key point is that I'm a shareholder like the rest of our owners, and I'm very focused on driving value for our shareholders in everything we do. As is our team. I should make that clear. Revival Gold's management, directors, advisors own collectively 15% of the business. So we're highly motivated to do well by our shareholders.
Without being too specific, what does the right partner for a Revival look like from a strategic perspective? What is it that you need or can use to help you move faster?
Well, capital is one thing, for sure. We are now at an inflection point with the business, right? Two assets, over 6 million ounces of resource, PFS on a first phase at our Idaho project, PEA coming together on our Mercur project in Utah. Combined target production 150,000 ounces a year, with the potential to grow to 250, 300,000 ounces a year as we contemplate developing subsequent phases in these projects. So we're at an inflection point, and capital and the kind of capital that we have available to us, ideally long-term capital, and with a focus on shareholder-friendly capital being the priorities for our current investors. A lot of companies in our position start to move into streams and royalties and converts and other debt-like instruments a bit prematurely, in my view, and we want to avoid that step. There is a time and a place for debt and debt-like instruments, but we want to avoid that kind of capital and stick with long-term capital that aligns with our current owners as we grow the business. I don't know if I can be more specific than that, but that's how we think about it from a point of view of a shareholder.
I'm trying. I'm trying to get out as much as possible out of this and see where it's going. But I mean, I understand that you still cannot talk too much about it. In terms of timeline, really is where it all started, or where my idea started to think or talk about this. PDAC is right around the corner. Is that something that typically is good for deal making, or could be good for deal making for Revival, and where we're the stage at which the company is now?
Look, I think we've done our strategic placement. I think we set a limit at 5%. I mean, we certainly could have gone higher, but chose that specifically to keep it at a modest level of dilution before we put the PEA out. So our focus right now is entirely on getting that PEA done, and getting it done is on time and an optimally with an optimal result. So targeted completion the end of March, and I will absolutely want to get back on the line with you, Antonio, and talk through those results because we're really excited about where it's trending and where it can take us.
Well, let's do talk about it. Let's talk about the project, and it's again it's Mercer in Utah. That is your flagship asset and main focus for now. You just recently published an updated geological model. Can I call it that? How come? Why was this needed? What's really going on?
So we wanted to get generally an update on the PEA activities out into the market. It had been a while since we talked about our progress. And what I think is important for investors to know is that we've got a very firm press going on here, and there's a lot of work, a lot of details that come together in order to put out a financial result, an NPV, an IRR on a project like we're scoping out at Mercur in Utah. So some of the details. We remodeled the entire resource. That is to say, we built from first principles, going right back to the drill logs. And in fact, we used an application of AI software to read paper drill logs and put that into electronic format to add to the bulk of the information we had available to us. And this was something that hadn't been done before. 1,900 drill logs brought into the geological database. And why is that important? That's important because it gives us more specificity, it gives us more precision, and it allowed us to QA, QC, quality control all of the data going into our geological model. And of course, we did find errors in the data. And we were able to correct those errors, and we were able to create a model that we can have a lot more confidence in. And that's key as we move from geology and explorationists to engineers and potential development. You need to have confidence in the underlying geological model. So that was job one for us. Alongside of that, the metallurgical model, key to the recovery of the gold. And of course, we had completed in the fall 5-column leach tests to be able to establish recoveries for the material that makes up the geology at Mercur. And we were able to use that together with literally thousands of direct cyanidation test results, data, to model the recovery. So the details of this are complex, but for a geological model such as we have and a metallurgical model such as we have, it breaks down into blocks of ground. And each block of ground now has, among many characteristics, a grade and a recovery. And that allows the engineers to optimize for the open pit planning where we can get the best value from the deposit. So the geological modeling, the metallurgical modeling, the optimal plans and open pit concepts are coming together. We've also been able to do some trade-off studies, more trade-off studies around the location of where we put things. And a key factor here is to make sure we're putting things on private ground wherever we can to allow ourselves the quickest permitting timelines possible. And your listeners will recall that we are on private patented ground with our resource. That gives us a huge advantage as we think about permitting. And so we want to make sure that we optimize on that. And that's part of the mine planning process. The next steps really are around developing up capital estimates, fleet estimates, and all of those depend on throughput estimates and plans, and then also our operating costs. So a few more steps to go through here until it all distills down into a financial model, but we're making really good progress, and the intention of our release a few weeks ago was to update folks on where we're getting to.
Well, talk to me more specifically about what specifically has changed within your understanding of the assets profile, and then we'll move on to talk about permitting and you being on private ground and all that. But this work that you've done so far, what is it that it's specifically changing for you?
It's giving us confidence. Previously, we just didn't have the detail and the data quality control that would allow us to have confidence to a point where we could think about mine planning. It's one thing to have a geological resource and an exploration glean in one's eye. It's another thing to translate that into value from mining. And of course, these steps we take as mining engineers, going from resource to preliminary economic assessment to PFS to FS to detailed engineering, are all steps to increase confidence, reduce risk as we build value along the way. So that's the principal thing that we've been able to do, is build confidence in what we have. We are working with a more compact resource, one that's suited for what we're looking to mine here. And this is normal as we go through the process. We want to work with just the material that will underpin a mine plan. Of course, we'll have additional resources beyond that, which will continue to grow and will continue to build on with more drilling. But in the initial instance, our focus with this resource is the material that we can exploit and build out a mine plan. And in that regard, we've given a bit of guidance. We're looking at something that can generate 80 to 100,000 ounces a year of gold production. That's our target over a 9 to 10-year mine life. We'll see where we come out once we get to the final results, but that's our guidance to allow folks to understand how we're progressing through this. And I think to give some, again, to lend some confidence to folks that this is going to be a meaningful gold asset in the Western United States, one that could be a real gem for a company like Revival Gold as we look to build ourselves towards free cash flow.
Who is this PEA being prepared for, though? I mean, is it so that it communicates to market participants, speculators, what the asset's prediction profile might look like, and that it might indeed be a meaningful asset in the United States? Or is it intended so that a potential takeover is more easily negotiable, if you will?
So we do everything to optimize and deliver on Revival Gold's vision, which is to pursue a revival in gold, to pursue sustainable gold production, to deliver value for our shareholders, for the communities in which we live in and operate, and for our team members. That's what our goal is. Our goal is to deliver value for our shareholders by delivering growth in gold and free cash flow from gold. So that's our objective. We don't concern ourselves so much with others along the way here. We cannot be looking in our rearview mirror at all the corporate interest in what we're doing. If we do good work and we deliver high quality free cash flow, I think investors and others will come. And that's the value equation for us, delivering high quality work and moving to sustainable free cash flow.
How far up the Lassonde curve would you guess that you have to take Mercur before a mid tier, for example, gets interested in this? Is it a PFS level? Is it an FS level? Would a PEA level be sufficient? What do you think?
I think the moment we acquired the project, we had interest from mid tiers and others. I just got to step you back a little bit here, Antonio. This is a Carlin type deposit in the Western United States on private ground. This is a very, very favorable situation. We've got historic production of 2.6 million ounces of gold. In fact, this property goes right back to the 1870s, when even before the state of Idaho came into the Union. It's been explored. It's been a successful producer of gold. It's launched the career, so to speak, of companies like Getty Oil and Barrick Gold Corporation. So we think it's a real special asset. We've got two limbs to the anticline that makes up the geological formation. And just one of those limbs has been explored and developed in a modern sense. So there's a whole other side to this property on the West Mercur, which we think is really exciting exploration team, and which our chief geologist, Dan Pace, and his team are evaluating and developing up target ideas around. So, look, there's lots to this. A lot of reasons for corporates, both big and small, institutions, both big and small, to take interest in what we've done. Even from the day that we put this into Revival Gold, recall this was a private company that we acquired. And we've really started to bring the light of day onto it with our efforts as a public company to get the message out. And I think this PEA is just a first step in translating that exploration value into net asset value, into potential free cash flow. We are going to have to go through subsequent steps here, not the least of which is permitting. But this is a first step.
Why I'm asking you these things, or why I'm trying to figure out what's going on that front, is because I'm still thinking about it. Can this be a standalone asset? Because you say it's going to be a significant asset, or you assume that it's going to be a significant asset in the US, but can it be a standalone asset, or is this really something that has to go with somebody else?
I think it can be a standalone asset. We're talking about something 80 to 100,000 ounces a year, something that could generate at current gold prices, upwards of $300 million of revenue a year. That's a substantial asset in anybody's book. And at current margins in the industry, running over 50% over AISC, these things can be tremendously profitable. So, it's a material asset by any measure, and you couple that together with our Bear Track Arnett project in Idaho, some 4.6 million ounces of gold, open for another 5 kilometers to the south with favorable structure. Not only are these meaningful assets, but these are meaningful assets in the context of some of the biggest companies out there that mine gold, and some of the biggest investors who invest in companies like ours. And this is one of the differences between Revival Gold and many of our peers. We have a portfolio of projects which we can develop from a modest capital base, such as we sit today, and we can move to free cash flow, but at the same time have potential for scale. And from an organic portfolio of exploration and development, we do not have to go out and buy a pan project in order to launch ourselves into a Valentine Lake project, as we saw Calibre did as it grew its business, because we can deliver pan-like production and more from our existing portfolio, and then move to Valentine Lake scale of production from our assets, and all within the organic portfolio. So I draw that parallel. We are in a growth business. We do think that's a sweet spot for investors, and we can do it organically if that's where all that we ever do as a company. I have much greater ambitions than that, and I know our team does as well. But if that's all we ever do, we've got something that's of interest to all investors in the gold space, and corporates in the gold space, because of the scale, because of these geological systems.
You mentioned that you're essentially going for the low capex route here, and I know we'll know more about it in 2 months' time from now. But what's your expectation for OPEX and all-in sustaining costs here in that case? Because to determine whether this works as a standalone asset, we also have to know that we kind of have to know what the potential profitability profile would be. If you look at what your neighbors have achieved, or maybe if you look at it from a historic perspective, what do these assets typically operate at?
Yeah, so we're seeing average heap leach projects in the United States and let's talk about Maine, lower 48, United States. We're looking at something in the order of typically around $1,400 all in sustaining costs. I don't know where we're going to come out with Mercur, but that's where we're typically seeing them at right now, relative to a gold price of about twice that. Hence the 50% margin I talked about earlier. And the typical grades we're seeing in those projects runs anywhere from 0.2 grams per ton gold to about 0.7 or 0.8 grams per ton gold, typically around 0.2, 0.3, 0.4 grams per ton gold. So I think we're sitting really well here at about 0.6 grams per ton gold at Mercur. And I think we're going to see that the all-in sustaining cost is going to be competitive with any of our peers. What's more important, I think, is the capital cost, the initial capital cost that we may see here, because we're on a site that's been it's a brownfield site. We have power to site. We don't have to build a power line. We have a transmission station on site. We have a paved road into site, and we're 30 or 40 minutes from a town of 40,000 people, about an hour from the town of the city of Salt Lake. So we've got really good access, and we have water available nearby to satisfy way more than what we need in this initial heap leach phase. So all of those things mean that we have a relatively modest capital. We're targeting something in the order of around $200 million plus or minus for this project. And if you kind of go through the math here, we're plus or minus based on what we're seeing here, something that would fall in line or better than any of our peers based on having that infrastructure. And that infrastructure also saves us time. So time of permitting and time to construct, and that allows us to move more quickly to free cash flow on both fronts. So some real advantages. We'll have the numbers, Antonio, when the PEA comes out. I've got to be careful not to get ahead of that work. And I think that's some of the pieces here that folks are going to want to digest very carefully. And I'm very optimistic about what we're going to come up with here. We're excited about what this project can deliver relative to those questions you're asking me.
Well, I should be patient. That's not one of my virtues. And I should try and improve that. And I know we touched upon it in our previous conversation, but given that we have more time today, it might be a good idea to talk more specifically about the permitting process in Utah. You're mentioning you being close to some of the cities. Good from an infrastructure perspective. Could it maybe be a challenge from the perspective of permitting? And maybe you could walk me through it holistically and explain to me what you need to do to go from where you stand today to where you're essentially pulling ore out of the ground and selling gold.
Yeah. So the first thing is a supportive community, and Utah, the state of Utah, was recognized as the #1 place in the world for investment in exploration and mining last year by the Fraser Institute. Ahead of Nevada, ahead of any other place in the world. So just to give you a general flavor for support for responsible exploration and mining in the state of Utah, more locally, we're close to a town, Tooele. About 40,000 people live there. It's a blue-collar town. And our engagement thus far with the municipality has been very favorable. Folks remember the successful past of the Mercur site. I mentioned that the mining activity, the exploration and mining activity extends back to the 1870s on this site. So there's a real appreciation and understanding of the value that comes from the economic activity driven by responsible exploration and mining at the Mercur site. And importantly, we don't have any environmental issues or challenges around this site. It's got a really good track record. So that's our neighboring town of Tooele. But some people have nice towns nearby, but also nice landscape and the issue of recreational homes in the vicinity. Fortunately for us, we don't have that issue. In fact, Our nearest neighbor is the U.S. Department of Defense that runs a weapons destruction site next door to us. So we don't expect to have any challenges from our neighbors around things like dust and noise. And certainly that's the past record with respect to mining activity at the Mercur site. No issues with the local community or our neighbors, the Department of Defense. Beyond that, I can speak to a couple things. First of all, I'll repeat again the resources on private patented ground. That drives us to a state process for permitting as opposed to a federal or NEPA process, National Environmental Protection Agency. And that's really important to us. It's because it allows us to move through a more efficient state regulatory process. The federal process is cumbersome. There's a lot of regulations. There's a lot of steps that one has to go through, and it's very cumbersome. The other thing about our site is that it's in a semi-arid location. So what that does for us is it means that we don't have to do the typical 3 years of water baseline collection to ensure that we're looking after the water resources. There are no water resources of note here. There's not a lot of surficial water, and there's no groundwater that we have to worry about. So that saves us on 2 counts. And then more generally, I'll talk about the process in Utah. We'll work through what's known as the Department of Oil, Gas, and Mining, DOGM, in Utah. And Utah has built a really interesting and constructive path forward for operators such as us. The state coordinates all state and federal agencies that are involved in a permitting process. And so that reduces overlap and it ensures coordination through the permitting process. We have had some initial discussions through our consultants and our technical team with DOGM, and we have a really good feel for where they're at on this. And thus far, it's been nothing but support and encouragement, and that bodes well for the process here generally. The next step for us, alongside of the PEA, will be to map out all the specific permits and the timelines and the requirements and the activities involved. But I'll come to the short bit, which is you're wondering how long it's going to take to permit this. We think it's going to be less than 3 years. We'll have more details around that, Antonio, once the PEA is out and we've had a chance to finish off the scoping for the permitting exercise.
When you say 3 years, is that what are you specifically talking about? Like being fully permitted? I mean, is that really doable?
It is doable. Absolutely.
That's it's an interesting timeline because you typically hear about these grave things about timelines in the US being very long, sometimes multi-decade timelines that is what we get to hear in popular media, at least.
Yeah, and so the specific situation matters. It matters if you're in on public land. It matters if you're next to a river or you're having to move a river, as is the case for Perpetua on its Stibnite project. It matters if you're in a very wet area that has a lot of water, and water is important. We have to take care with water around mining and in the West generally. It's a scarce resource, so we have to look after it. So those things matter, and they can complement permitting processes. If you're on private ground, if you're in a semi-arid location, if you're in a spot that doesn't have any indigenous involvement or activity that causes complications around permitting, if you're in a place where you have neighbors who might not be on the same page with mining activity in their backyard, those are things that complicate permitting processes because there is involvement of the public through these processes, and you want to be in a place where people are supportive of the jobs that come from responsible exploration and mining, and the education, the infrastructure, and all the things that we bring bring along with these projects.
Hmm. And part of that is, I assume, well, you touched upon it really just now, but you don't need an EIS. It's a state level EA that you're going to have to do.
Yeah, we'll have more specificity around that, but the short answer is at this point we think that it'll be an EA process rather than a more cumbersome and involved EIS process.
Right. Do you have any specific comps where that's actually happened and it's happened that quickly as you think it's going to happen for you?
Yeah, there's lots of examples of that. Um, uh, um, uh, there are lots of examples of working through an EA process as opposed to an EA process. In Arizona, this has been done. In Utah, this has been done. Um, uh, you'll find that in states like Idaho and Montana, there is a lot of federal land, so it's unlikely that you have a project that doesn't intersect with the federal nexus. We know all about that, of course, because that's what we have at Bear Track Arnett in Idaho. And even though that project is on an existing plan of operations, and even though we've got 30 years of baseline data collection there, it's going to be 3.5, 4 years to complete the permitting process at that project. So where we're located in Mercur in our Utah project, we think it'll go a lot faster for that reason.
What's the size of the bond that you'll be required to put down, and what's kind of the stage, or what stage is that really needed? When do you have to start building that?
Yeah, we'll have more details on that, Antonio, once we have a permitting schedule and once we have an idea of what actually has to be bonded.
Right. Okay. And that's what, on the back of the PEAs when you expect to have that?
I don't know that we'll have a bonding estimate on the completion of the PEA, but we'll as we develop up our so the steps are this. First of all, we have to have a plan. And before you can decide what needs to be bonded, you need to know where you're going to be moving material.
Mm.
So first we have to have that plan. And then we have to decide with the regulatory agencies what exactly needs to be permitted and how, and what is the reclamation plan around that, and how long will it take? And then you have to do cost estimating on what it will what it'll take to bring things back to satisfy the regulations that apply. And so all of those steps take time to develop. I can tell you, generally speaking, bonding on projects like this runs anywhere from $5 million to $30 million. I mean, I can give you that range. Typically, that's what we see.
Is that good or bad?
It's a lot better than what we see in wet climates. It's a lot better than what we see in tailings operations. Open pit heap leach mining is relatively benign stuff, especially in a dry climate, and especially on a flat location. There definitely have been issues around closing heap leach mines, but those are typically and operating heap leach mines, but those are typically where you've got complicated geotechnical situations, permafrost or terrain that's complicated. Or you are working in extreme weather conditions, or you are working where there's a lot of water, and you have to deal with the water runoff and all the complications around that. So we're in a pretty benign location from a permitting point of view and from a permit bonding point of view.
That kind of gives me a good idea, really, of what the permitting process might look like. I get what you're doing at Mercer right now. What else has to happen between now and the PA has been published?
Yeah, we're heads down on all the details. It's a really busy time for our team. So um, I spoke a little bit about the capital cost estimates. That will depend on fleet size, and it will depend on where we land with throughput. So we'll do some trade-off analysis and optimization around throughput. Sorry, just to bring you into the tent, the bigger the project we construct, the bigger the capital cost, the lower the operating cost, the shorter the mine life, the better the NPV of those cash flows. So we're trading off capital costs versus mine life, and bringing those cash flows forward. So we're doing a bunch of those sorts of things, and then of course once the throughput is landed on, then we can land on our fleet size. And then there's a nuance around the fleet size because we have two operating areas. Generally, we have Mercur, the main Mercur area, and then we have the what's known as the South Mercur area, which is call it 3 kilometers or 4 kilometers south of the main Mercur area. And so what we'll want to do is we'll want to figure out which one of those places we go to first. And depending on which one of those places we go to first, we'll need a different sequencing of the equipment coming on stream. Bigger starting place means more equipment. Smaller starting space means less equipment to get going. So we want to optimize around that. We want to optimize around the location of where the heap leach facility will be. So all of that's taking place. And that'll drive capital costs, and then operating costs will fall out of that as well. And we've got some really good, examples and recent relevant data. I should mention that our lead engineer, our VP engineering development, John Meyer, has done this many times before. He's got a ton of experience both on the permitting optimization side, on the engineering optimization side, and on the financial value optimization side. And he's driving a team, not only our internal team, but we've got Kappas Cassidy on metallurgy and financial modeling and mine planning. We've got Respect on geology and mine planning and pit design. And we've got our environmental consultants as well under that umbrella. So there's a lot of work going on right now to drive capital, operating costs, optimizations on all those things, and then ultimately the financial value that comes out of that. And then we wrap a bow around it with the technical report, 43-101 technical report. There's a lot of work that goes involved. It's involved with the tables, the presentation of the figures, and all the data analysis, QA/QC, and related reporting. Everything from the land position and ensuring that we've got an up-to-date and all of the corrections done with our land position, our title situation, a title opinion. All of that gets wrapped into a technical report, and it's of huge value to investors. These things tend to be very lengthy, so we'll distill it down into a press release. But the technical report will follow about within 45 days of the press release, and I do encourage your audience to go and read these things. There's a lot of value in there, everything from a summary of key risks to key opportunities, recommended next steps. All of those things are in these technical reports.
So exciting stuff like financial modeling and mine planning. That's what's happening in the meantime, essentially, in one simple sentence. What about news flow? What kind of news flow are you going to have between now and the PEA?
I don't expect a lot of news flow, Antonio, to be honest. We're heads down getting this PEA together. We will close the transaction with Dundee Corp here at the end of this week, and so we'll announce the close of that transaction. But it's heads down. We're busy on the PEA.
So no exploration budget for Mercer this year then?
Not right now. That'll come out of the PEA. We want to formulate those plans based on the recommendations that come from the consultants around follow-up to the PEA.
Okay. Well, I'm getting at you. Well, at least partly, or at least I can pretend that I am, but I'm really working with 3 very tired brain cells here, so you're gonna have to give me some rope. With these last 2 developments, is Bear Track or Net taking kind of more of a back seat for 2025?
Yeah, I think from a point of view of who's going to get quick, faster to production, it's clearly Mercur. I mean, we've got so many advantages there, but it does not diminish the value of Bear Track Arnett to our portfolio. And remember, we're building growth in gold. We've got tremendous exploration potential at Bear Track Arnett. So while we progress the permitting preparations on that project, we will continue to explore. And we did that last year with geophysics, soil geochem, and extensive mapping program, modeling, developing up targets for future drilling. And I think we're itching to get back in there and do some more drilling. So this is an important asset for us. It's not the one that's going to go first into production because it is on, for the most part, public land, and it is a more complicated process, but it's an important asset, and there's a ton of value to be surfaced from that project, and we'll continue to do that.
Would you be looking or actively looking for a partner on it, a JV, or an option agreement, something else?
I don't think so. I think there's a ton of upside to that project, and we have the team, including the former general manager, Pete Blakely, on our team, who ran that mine and operated it. So we have the technical capability. We definitely have the targets and the skills to advance the project. No, I don't see any reason to joint venture it. Unless there's something that comes along that's particularly exciting for our shareholders. I think we want to continue to surface value from that project. Our finding cost to date at Bear Track Arnett has run $6 an ounce in the ground, and we see at least double the favorable structure on this project, and so it's pretty exciting, pretty exciting exploration to continue to advance while we move to production on our Mercur project. And if you think about it, it's synergistic. We get into production on one project, and we can use those free cash flows to drive value at the other project, and continue to move towards our grander ambition, which is, of course, to be a 200,000 or 300,000 ounce a year producer, and to do so all from the Western United States.
But not much is happening then in the meantime over at Bear Track Arnett. I mean, you first want to see like all the focus, all the money, all the attention, all the effort goes toward Mercer, and then if and when that's profitable or cash flowing, that's when you go back to Bear Track Arnett.
I think we can spit and chew gum at the same time. We will continue to progress. If you think about the Revival Gold portfolio as a portfolio, first up is Mercur towards permitting through to free cash flow. Next up is Bear Track with its baseline activities as we build towards permitting there, and then the caboose in the pipeline is exploration, and we'll continue to do that. And if you think about our skill sets too, we have engineering, permitting, and exploration all in-house, and able to move these things along efficiently. And one is a handoff to the others, right? So there's a ton of operating synergy in that. These projects are very similar in the first phase, open pit heap leach. And so there's a lot of transferable skills and expertise from one to the next.
I also wouldn't assume, but this is just another kind of typical question that I ask here. I wouldn't assume it's true for you, but would you be looking to get into new projects or get something else into the door so that you maybe diversify outside of the US, or is really the idea to focus on these two things in the meantime?
Well, from the beginning, we've said, and I've mentioned this already, that our objective and the way we deliver value for our shareholders is through growth in gold. So we are always looking at opportunities to augment and build on our portfolio and the opportunities for our shareholders. I would say those are few and far between, though. I mean, we looked at, I'm going to say, close to 200 different opportunities before we landed on buying Ensign Resources last year and acquiring the Mercur project with that. So we will continue to look, keep our eyes open to opportunities. There's nothing on the horizon immediately. We see tons of value creation with what we have on deck already. But one never knows, and one needs to keep one's eyes open because opportunities do emerge, and you have to be ready for those opportunities. So we'll keep our eyes open. Generally speaking, though, for us, we've got a ton of value to surface. Stock's trading right now at about $7 an ounce in the ground. We've just had this major validation from Dundee Resources. They did a lot of technical due diligence. Investors can feel very comfortable with what we have. There is a lot of corporate interest in what we're doing, but I think we can efficiently finance our activities and continue to grow the business. And stay tuned here as we come out with this PA just within the next couple of months.
Well, that about does it. And that about summarizes what we have to look forward to. So I think I'm out of questions for now here, Hugh. What am I forgetting to ask you? What did you come here hoping to talk about that I failed to bring up?
You do a great job. You managed to barbecue your CEOs on the CEO barbecue, and it's great to have this conversation. Thank you, Antonio.
Thank you so much for your time today. And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. Also, unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."